Welcome back, everyone. Next up, we have UR Energy Inc. It trades on the New York Stock Exchange American under the symbol URG and on the TSX under the symbol URE, and is a uranium mining company operating the Lost Creek in-situ recovery uranium facility in south central Wyoming. They've produced, packaged, and shipped approximately 2.6 billion pounds of U3O8 from Lost Creek since the commencement of their operations. Please welcome back CEO John Cash. How you doing, John?
Hey, doing great. Thanks for having me back on, Anna. I really appreciate it.
Yeah, we look forward to hearing your updates, so take it away.
Yeah, thank you. I'll just jump right into the slide deck and do the presentation here. We always like to start the presentation by showing our Lost Creek operation. We are up and running. The guys are out there producing pounds of uranium today. And the photograph is the inside of our processing plant. Those are ion exchange columns. I know they look like minions, but they are ion exchange columns that collect uranium. And then the barrels on the right-hand panel, that is our first shipment of yellow cake that we sent out in 2013. And as Anna indicated, we've produced about 2.7 million pounds of uranium since we got up and running. So we have the standard disclaimer. Please be aware that I may make some forward-looking statements during the presentation. Also, we encourage you to read the risk assessment that's on there as well and do your own analysis before investing. We have two flagship properties that I'll cover today. We have several other exploration properties and development properties, but we'll focus just on two of them today. The first is Lost Creek, which we've already mentioned. It's been in production now for over 9 years and has produced nearly 3 million pounds of uranium. Back in 2021, we recognized that the uranium price was beginning to recover and return. So we said, hey, look, we got to get it back out there, get ready to ramp back up to full production. So we initiated a drilling and construction program that's been ongoing ever since. And it's been going quite well. We have our header house 2-4 that's under construction right now and nearing completion. And then all of the wells for header house 2-4 have been installed, and we're moving on to header house 2-5. And so we can ramp up very quickly at Lost Creek when we get that market signal via contracts, which I'll talk about a little bit more a little later on. So we have a great resource at the project, nearly 12 million pounds of measured and indicated resources, and an additional 6.6 million pounds of inferred resources. And Lost Creek has a really good reputation of being a solid producer at a very low cost. Back when we were producing at our highest quantities, 2016, 17, 18, those years, we were getting down into the range of $16 a pound of C1 cash cost. The all-in mine site cost was about 33, and then corporate overhead on top of that pushes us into the 40s. So if you look at the market today, the spot price is around 50. The long term is 50 or a little higher. We are in the money right now. And I would point out that the published prices for uranium, those are global prices. They don't represent necessarily what contracts are being issued at for Western pounds, because the world now is moving toward Western pounds because they want the security and they're willing to pay for that. And we are seeing that in our conversations with utilities. But Lost Creek's got a really good mine life. Based on the resources we know to date, we believe we can mine for 14 years, and we have ample opportunity to continue to explore. And I'll show a map a little bit later in the presentation that shows the areas that we can continue to explore. Lost Creek, the mine itself, has a licensed and physical capacity of 1.2 million pounds per year. The plant has a capacity of 2.2 million pounds per year. The delta between the two was very intentional. We would like to be able to bring in material from our other mines or from competitors to do toll processing at our mill, in the photograph there in the top right. So we expanded that capacity during licensing so we could bring in those additional pounds. And for example, our next flagship property, Shirley Basin, we would like to be able to bring pounds in from Shirley Basin, truck them over to Lost Creek, and finish the processing there. That allows us to only build out the very front end of the plant at Shirley Basin, and that's a tremendous cost savings for us since we only have to build out the front end. But Shirley Basin is our next facility that we plan to go to. It is licensed and permitted and construction ready. We have all the major permits necessary to move forward. When we do construct it out, the well field there has a licensed capacity of 1 million pounds per year. If we built out the entire plant facility, it would have a capacity of 2 million pounds per year, which would bring our total company capacity up to 4.2 million pounds per year. Shirley Basin has a great resource in the ground. It's very shallow, very good grade, 8.8 million pounds. And Shirley Basin, we believe, is probably the first in situ uranium mine in the world. They started in situ mining there back in 1963, simply as an experiment to test an idea, and it worked incredibly well. They produced well over 1 million pounds during that time frame. They went on to mine conventionally there and produced well over 20 million pounds. So it's a very prolific district, and we're excited to go back in there and apply in situ to recover the 8.8 million pounds. But looking more broadly at the company, just a few statistics here to pass on to you. We do have a very good inventory on hand, 324,000 pounds. The vast majority of that we produced at Lost Creek. The Department of Energy, at the direction of Congress, has established a uranium reserve. It's very similar to the petroleum reserve, but for uranium. And they've got that program established now, and we have supplied a bid to begin filling that reserve. And we expect to hear back from DOE by the middle of December, whether we've prevailed on that bid or not. We also have recently signed our first sales agreement that we've had for a while, and it's a 6-year agreement with a major U.S. utility. I'm under an NDA, so I can't disclose who the contract is with or the pricing on that, but it is for 6 years and with a annual quantity of 200,000 pounds. So I've used the term in situ a number of times here already in the presentation, so I should define that. Some people may not be familiar with the type of mining we employ. But the photograph here is an in situ mine. This is our Lost Creek mine. It's operating, it's producing pounds right there. So in situ means in the place. It's a Latin term. So we don't do digging. We don't dig adits or have open pits. What we do is we install water wells, and in those water wells, we inject water, baking soda, and CO2, and oxygen as well. And those chemicals in combination with each other will dissolve the native ore body underground, and then we simply pump it to the surface and recover the uranium and return the groundwater to back into the ore body to recover more uranium. The great thing about in situ is it's low capital cost, low operating cost, and the footprint is incredibly light. As you can see there, that's the operating mine. We've got deer and antelope that routinely come and visit us and graze out in the field there. And so wildlife is everywhere. When we get done, we'll remove those wellheads, do some groundwater restoration, and when we leave, it'll be free release, unrestricted. That land can be used for anything. So I'll switch gears a little bit, move away from our projects for a few slides, and I'll come back to them. But I want to talk about the nuclear thesis or the investment thesis. But primarily, people began moving toward nuclear fuel and nuclear power a few years ago because the realization really set in that renewables, while they're great and they have their place, if we are really serious about having a conversation of going carbon free, nuclear has to be a part of the story. We can't get there just with wind and solar, or at least not at this time. We simply don't have the storage capacity for that energy. And the sun doesn't always shine and the wind doesn't always blow. But we already use a lot of nuclear power globally. In the US, about 20% of our electricity is derived from nuclear power. That shocks a lot of people. They're very surprised to hear that. And about half of our carbon-free electricity in the US is from nuclear power. Right now, globally, there are 436 reactors up and running. An additional 60 are in construction right now. And there are 100 reactors on order and 300 proposed. And I'll get into those numbers a little bit more in the coming slides. But in summary, the World Nuclear Association, the WNA, is projecting tremendous growth year over year through 2040. In their base case, 4.2% annual growth. In their upper reference case, 7.9% annual growth. And I should point out that study was done in late 2021. And they only do the study every 2 years. So it'll be September next year before they redo the study. But importantly, that study was performed before Russia invaded Ukraine. And that's important because a lot of countries in Europe now are saying we can't rely on Russia for natural gas. So going forward, we have to go to something else. And they are making a big move toward nuclear power. So electric generation is really the key output from nuclear power. But the world is also looking at other commodities that can be generated with nuclear, and hydrogen is on that list. And there is a global move afoot as well to utilize nuclear power, since it is carbon free, to generate hydrogen. So there are companies here in the US and in Europe that are beginning to integrate those circuits with their nuclear power plants. Crypto miners in the EV market, they also understand that they really need a good, reliable baseload source of carbon-free power. And so they are very interested in nuclear energy as well. And very importantly, maybe not in the near term, but in the midterm, small modular reactors, SMRs, they are being developed in a number of countries around the world. And in fact, they're already in operation in 3 countries. And not too far from where I'm sitting right now in Casper, Wyoming, Bill Gates is actually licensing a small modular reactor here on the west side of Wyoming. It will be used to replace a coal-fired power plant that is being shut down. And recently, Mr. Gates and his company announced that in addition to that one, they have identified 4 other sites between Wyoming and Utah where they are looking to replace the coal-fired power plant with a small modular reactor. And his company is called TerraPower, and they are expecting to have that licensed and constructed the 2027-2028 timeframe. Those small modular reactors, they are a few years out, but ultimately, as they catch on, we are expecting increased demand from them. And I won't go through the entire slide here, but I do want to point out all of the nations around the world that are really beginning to move toward nuclear power, but I'll focus just on China, the very top line. They are in the process of moving toward constructing 150 reactors. I didn't misplace the decimal there. That's correct. 150 reactors in the next 15 years. And they've indicated that they are on target to complete that work. But other countries around the world also are really doubling down on nuclear power. Even Germany, probably in years past, was probably the most adamantly anti-nuclear. They are now keeping their reactors up and running. Why? Because they can't rely on Russia for gas. And there's just a long list of countries that are moving toward nuclear in a very serious way. Here in the US, we have 2 reactors that are being constructed in Georgia by Southern Company. They are going to be put online, one late this year, one early next year. But in addition to that, we also have a lot of government support in a very bipartisan way. The U.S. Uranium Reserve, which I already mentioned, that was passed in a bipartisan bill, and $75 million was allocated to that program. Also, the Civil Nuclear Credit Program and the Inflation Reduction Act have been passed in a bipartisan manner, and they provide billions of dollars of support to the existing fleet here in the U.S. Probably the most profound measures ever taken to support nuclear are those 2 acts, and especially the Inflation Reduction Act. But going forward on pending legislation, we have got 2 great champions. One's a Democrat with Manchin, and one is a Republican with John Barrasso here in Wyoming. And those 2 gentlemen don't agree on a lot of things, but when it comes to nuclear power, they're in agreement, and they've been very good champions for the industry. We also have a lot of support out of the White House, who really recognizes the importance of nuclear in the carbon-free story. But as nuclear began to catch on and the excitement grew around it, starting a couple of years ago, the financial players recognized that and really started to jump in. So there was a lot of new investment. But the real game changer was the Sprott Physical Uranium Trust that was established in July of last year. It's a trust where pounds can be put into it, but they cannot be sold out of it. So it's one way. But Sprott will use an ATM to raise money on the market, then deploy that capital to buy physical uranium to put in the trust. And they've acquired nearly 60 million pounds of uranium for that trust, and that continues to grow. And they put a lot of pressure on the market. When they're in buying pounds, we know it. We really, really feel it. And so that's been a real game changer for the industry as they mop up a lot of the mobile inventory. There's very little mobile inventory left out there. So geopolitical risks. We can't have this conversation without talking about that, because Russia is such a major refiner, not miner, but a refiner of uranium. and they supply about 43% of the world's enriched uranium and 38% of the world's conversion capacity. When I talk to people about this, they're surprised to hear that we continue to import uranium from Russia into the U.S., but we do. They supply 20, maybe as much as 23% of our demand for our reactors here in the U.S. And the reason that they continue that is because replacing that supply with Western capacity is very, very challenging. The capacity simply isn't there. It needs to be ramped up. It needs to be constructed. So replacing that is very challenging. Switching to mining, we have to look at Kazakhstan. They supply nearly half of the world's primary mined uranium. And of course, Kazakhstan is under the control of Russia. They are making good strides to move away from that. But ultimately, I think Vladimir Putin exerts a lot of pressure and control on Kazakhstan geopolitically, but also because Russia has ownership of several of the large mines in Kazakhstan, at least joint ownership with a company called Kazatomprom, which is owned by Kazakhstan. So there's a lot of control there. Kazakhstan is now having trouble shipping uranium out of their country because insurance providers don't want to allow it to go through Russia. They don't want to be subject to that risk. So Kazakhstan now is having to look for alternate routes to ship out material, and it's quite challenging. There really are only two other routes, one through China, which is very difficult and long, and the other one would be through the Caspian Sea, through Turkey, and through several of the European countries there. That is also very challenging because it's going from land to sea, a lot of loading and unloading, and also some of those nations don't have a regulatory regime that is capable of regulating shipments of radioactive material. So those shipments have become a bit tenuous, and we'll see what Kazakhstan can do to ameliorate that situation. So if we look globally and talk about where can those pounds be replaced, what country can do that? If we start with the continent of Africa, some of those mines, especially the large ones, have been purchased by China. So those pounds now are not going to the West, they are going to China. If you look at Canada, which was formerly the world's largest uranium mining country, their mines have been offline for some time. Just now, they are restarting two mines, McArthur River and Cigar Lake. But even though those are great mines, very high grade, and have great capacities, they are nowhere near big enough to offset a supply disruption out of Kazakhstan. And the story out of Australia is similar. There is some production out of Australia, but their ability to ramp up to a larger degree is somewhat limited. But that brings us to the U.S. Here in the U.S., we are now 100% dependent on imports of uranium. You can see from the chart that's produced by the U.S. government that mining here in the U.S. has effectively gone to zero. Very unfortunate because we have the largest fleet of nuclear reactors in the world, and we used to be the largest uranium miner in the world, and we are ceding our position there. But that's where I'll switch gears, and I'll come back to URE Energy on our properties. Lost Creek is very scalable. We've got a fantastic resource in the ground, 6.6 million pounds of inferred and nearly 12 million pounds of measured and indicated. We've got a great history of a very high recovery rate. Typically in the in-situ industry, the recovery rate is 60 to 80%. We are experiencing a 90% recovery rate over 9 years on average. And the map there on the left, it shows Lost Creek in blue. That's where we are currently mining. But all of those areas in the green surrounding, we have the mineral claims on those. And we have tremendous opportunity to grow the resource by moving into those areas and exploring. So I've talked about how we are a low-cost producer. I'll draw your attention to the year 2015. Our average cash cost that year, $16.27 a pound. So you can see we can get very low on that cash cost. We can compete with most companies in the world, especially any Western publicly traded. We can compete with any of those. And our main competitor that we're trying to catch up to is Kazakhstan, and we're making strides in that regard. And I'll talk about that shortly. But we have a very low-cost production coming out of Lost Creek. Real pounds, a very good resource, and we believe we can get back to that low cost going forward or very close to it. Taking another look at Shirley Basin, 8.8 million pounds of shallow drilled out resource. It's a very high grade deposit. We made the acquisition of this deposit back in 2013 because it's shallow and it's drilled out. So the cost going forward is fairly small. In fact, we believe we can get to a lower cost of production here than even at Lost Creek. We believe we can get below $16 a pound. We are primarily on patented mining claims, so we own the ground, so the holding cost is very low. And a lot of the infrastructure is already there because it's a brownfield project. So the roads, power lines, even some of the buildings are there, so we can minimize our cost when we develop that. Shirley Basin, we can build it out in a time period of about 18 months and get it ramped up, and at a cost of about $30 million. And that's pretty remarkable, but that's because it's an in-situ mine. And so the capital cost and the speed are fantastic compared to conventional. So going forward, we're going to continue to construct and drill at Lost Creek to move ourselves closer and closer to ramp up. And we're going to continue with delineation and well installation. We are very aware that there are supply chain issues, and we have had an advanced purchasing program in place for nearly a year. So we feel we're in a very good position there to continue to construct and ramp up. We've been able to keep our very key senior staff even through the downturn, and we've now begun hiring additional staff. And we've had some good success with hiring, and we're eager to get ramped up. So a little bit on ESG, a couple of slides there. I'll just hit the top bullet here, but if you take a look at the resources we have in the ground at Lost Creek and Shirley Basin and the energy output from those, and you compare that to a coal-fired, we'll offset about 312 million metric tons of CO2. That's the equivalent of taking 67 million cars off the road for a year. So the resources we are recovering will have a tremendous impact on CO2 emissions, and we're very proud of that, and we'd like to talk about that. And we're taking a number of other steps to reduce our footprint. In fact, if I look out my window to my left, we'll see we're building a new shop here in Casper, Wyoming, and we'll do a lot of our construction here so our guys don't have to travel out to the remote mine site. We do use the in-situ technique, which has a minimal footprint, and we're working hard to increase our recycling of water. But that takes me to R&D. We have a reputation at URE Energy for R&D. That's in our heart and mind. That's what we love to do. We've had a number of successes there listed in the top, and very often our competitors here in the US, they follow suit. So we'll come up with a new technique, a new permitting process, and they'll follow suit. We've announced 2 ongoing research and development programs. And in fact, just yesterday, we came out with a press release on the first one there on well casing and installation. And we've finalized our phase 1 testing on that technology. And we've got a patent now for it and LQD approval to proceed with additional testing. And what we're seeing is we can reduce our drill rig time on injection wells by greater than 70%. And looks like we can reduce our cost by about $2.50 a pound to $3.50 a pound for our production going forward by utilizing this technology. So we're very excited about that. That is a huge cost savings. It's very hard to save that much money by coming up with a technology, but our guys have done that, and they've done a great job in the field. Going forward, we will be doing some additional testing on flow rates and development technologies associated with that. We are also going to be doing a hydrologic model to see if we can change the geometry of our injection patterns from a 5-spot to a 7-spot as a way to try to improve flow rates and efficiencies of mining. So more to come on that, but I would encourage you to take a look at our press release that came out yesterday. It's incredibly exciting. We are also working on another R&D project to work on water treatment and filtration. We are wanting to recycle more of the water. And so we're making good strides there on that R&D project, but it will be at least a few more months before we have more to talk about there. So our fully diluted market position of 242 million shares outstanding, cash position on toward the end of October, 37.3 million. Market cap hovers right around 280 million. We've got a great inventory that's worth about $16.5 million that we can convert into cash very quickly. Our story is very liquid. Our average trading volume, if you look back over the average of the last 30 days, we're trading over 2 million shares between the New York American and the Toronto Exchange. We are listed on the Russell, and we have fantastic coverage by analysts, both in the U.S. and in Canada. And I think that's a reflection of the value of our company. We are seen as a leader in the industry, low cost, reliable production. So just to close it out, we are well financed, $37.3 million cash in the bank, about $16.5 million worth of inventory, and we are looking to ramp up. We need to bring in some additional contracts in addition to the one that we already have to justify that ramp up. That's my number one priority over the coming weeks, is to get those contracts in place. We are well in the money, and get those inked so we can ramp up and get back into full production. So with that, I'd be glad to take any questions.
Great job, John. You seem to be in a great position and excited for accelerating it. Let's talk about your new well casing technology. Can you tell us more about it and why you're assessing changing the pattern design from a 5-spot to 7-spot? Yeah,
absolutely. So historically in our industry, the well pattern, if you look down from above, map view, you have, it looks like a 5 on a die. So you have the 4 corners are injection wells, and the center well is a production well. That is the technology that has been used by most companies because it's relatively inexpensive. You only need 4 injection wells to 1 production well. So they're trying to keep the cost down. However, that leaves a lot of space that doesn't get addressed very well by the injection water. So we're looking at, since we believe we can reduce that cost of the well installation, we're looking at increasing the density of injection wells so we have a higher efficiency of sweep. That will allow us to mine more quickly, more thoroughly, and it will also allow us to restore the water more quickly as well. And time is money. So if we can add that efficiency into it, we're excited about that. It is R&D. I can't promise you what the outcome is going to be, but we're going to work hard on that to make it come to pass.
Fantastic. So how quickly can the Lost Creek and Shirley Basin mines be ramped up for meaningful production?
Yeah, you bet. So Lost Creek, when we get the contracts signed up, we can get up and running to a very meaningful rate in less than 6 months, and we're continuing to work to shorten that time frame. Shirley Basin, it needs to be built out. So the build out and the ramp up combined can be about 18 months. I know that seems fast, but when we built out Lost Creek, that full plant was built out in 9 months. So we believe we can do that. Our chief operating officer has done that several times, building out mine sites. He's quite experienced at it. And so we think we've got good line of sight on 18 months. And the capital cost there at Shirley will be about $30 million to get it up and running.
And so for Lost Creek, how many contracts do you need to enable that full ramp up of production?
Yeah, you bet. So a number of factors come into play here. First of all, it's the number of pounds, but the price on the contract is also very important. And the term is very important. I mean, for example, we don't want to sign just 1 or 2 year contracts. We really would like long-term 4, 5, 6 year contracts. So I would like to get 500,000, 600,000 pounds as a starting point under contract, then work our way up to 800,000 to 1 million pounds a year production at Lost Creek. Similar story at Shirley Basin to justify ramping that up. Would like to get at least 400, 500,000 pounds under contract to justify the ramp up there. But Lost Creek will come first. We'll get it contracted out, ramped up, and then we'll turn our attention to contracting out at Shirley Basin.
Anthony Palazzo wants to know about the status of this congressional uranium bill that's going through Congress and how that's affecting UR Energy.
Yeah, so there's a lot going on right now in Congress with regard to clean energy. Some of that impacts the nuclear. The uranium reserve has already been established. And so that is being stood up by the Department of Energy. Right now, there's legislation that's been put forward by our discussion of legislation being put forward by Barrasso and Manchin that deals with cutting off that supply from Russia. There's a lot of debate on how quickly that should happen. But that could be a very big game changer for our industry because we get so much of our uranium from there. So if that does get cut off, whether that be cut off in a year or 2 or 3, that will have a profound impact globally on the industry, and we would expect much higher prices. There are pinch points in mining, conversion, and enrichment, all 3 steps leading up to fuel. probably the biggest pinch point is conversion. Conversion prices right now are some of the highest we've ever seen, but that also has an impact on uranium demand as well. So yeah, we're keeping a close eye on that. We never rely on the federal government for our business model. We are commercial, but anything that the government can throw our way to help us compete with state-owned enterprises in Russia and Kazakhstan, it can be a big help.
Stan Juris wants you to talk a little bit more about the RFP demand and domestic supply, and who can submit a proposal.
Yeah, so the Department of Energy, they have very strict criteria on who can fill the uranium reserve. It has to be a U.S. production. It can't be pounds that were mined in any other place. And they are looking to accept bids from 2 or 3 companies. They're looking to purchase up to 1 million pounds, but they do have a limited budget of 75 million. That 75 million, it is divided between conversion and purchases of domestic uranium. So we don't know exactly what the breakdown or the ratio will be, but I suspect about 50 million will be spent on buying uranium and about $25 million on conversion. So the list of U.S. producers that can bid into that RFP is extremely small. It's probably 3 or 4 companies that actually are qualified to bid into that because it's so restrictive.
And we might have time for a few more questions, but Dominic Posey wants to know, what's your bottom dollar to sell your uranium and still be profitable with existing and future contracts?
Yeah, you bet. So that's not a number we divulge. We don't want to share that with utilities. I can tell you that, back in 2013, 14, 15, we were contracting, around $50 a pound, and we were very profitable there. So if you kind of want some idea of what we would like for pricing today, take that $50 price from back in 2015, let's say, add inflation, and that will tell you what we would like to see. We're not going to give our pounds away. It's a tremendous effort to be able to recover those. And we're not looking at 2 or 3, 4% profit margins. We're looking at much higher. This is mining. We're not buying municipal bonds here. It's mining. So we're looking for high percent returns.
Great. A few questions I'm trying to combine from Jim Singleton and Matthias Miner. Talk a little bit more about Shirley Basin and when construction will begin.
You bet. So it is completely predicated on contracting. And again, we'll contract out Lost Creek first because it's essentially built out and ready to ramp back up to full production. So that would be our lowest cost in the near term is there. So that's our primary objective. But as soon as we get that contracted out and ramped up, we will immediately turn our attention to Shirley Basin to be able to get it contracted out. And so we would like, since it's a satellite facility, we would like to have at least 400, probably 500,000 pounds under contract before we begin putting capital into the ground. We're a very conservatively run company. We're not going to go out and gamble with that capital by putting it into the ground to sell into the spot market. We're going to insist, like we always have, on having long-term contracts before we ramp up production, either at Lost Creek or at Shirley.
All right. And last question quickly, Matthias Miner wants to know how many employees are required for Lost Creek?
Yeah, for Lost Creek, we need about 55. Today, I believe we have 28. So we do have some hiring that we would need to do to bring it up to full production. We've had success on hiring. It's been much more challenging than it has been in the past, but we have been successful, very successful on professional positions. And we've nearly filled our book on the professional positions, but we do have a number of hourly staff that we would need to bring on. That's one of the beauties of in situ, though. We can produce 1 million pounds, 1.2 million pounds a year with 55 employees. That's a much better rate than for conventional mining.
Important stuff here. John, thank you so much. We'll send the rest of the questions to you so you can answer on your own, but good luck with everything. And we look forward to seeing you again on our conference.
All right. Thank you very much.
All right, everyone, stay with us. We'll be right back.